that come out of the trend towards greater consolidation. And in order to tease out these trends and to discuss these issues, we're really fortunate to have two fantastically well qualified guest speakers here to join our Mason Hayes and Curran panel. So let me introduce our guest speakers. First, let me introduce Hubert Vanier. Hubert is Global Co-Head of the Financial Institutions Group at Deutsche Bank Investment Banking based in London. And he has over 25 years experience of financial institutions M&A in the EMEA region, and clients that he has worked with during that time include Aviva, BNP Paribas, Generali, Munich Re, and Zurich Group. So welcome, Hubert, and we're very much looking forward to your remarks. And also joining us from here in Dublin is Stephen Kane, who's Director of Investment Banking at Goodbody Corporate Finance. He has a particular focus on the regulated financial sector, with nearly 20 years experience of advising financial institutions on ECM and M&A transactions in the Irish market. And clients that he's worked with include AIB, FBD, Finance Ireland, and the Department of Finance, among others. Can I remind you all, please, if you have questions for our guests or for the Mason Hayes and Curran panel members, to enter these in our audience Q&A function, and we'll leave time for questions at the end of the presentation. But I'm going to hand over without further ado to our guest speakers, and first to Hubert, and Hubert will then hand straight over to Stephen before coming back to me to moderate the panel discussion. So Hubert, straight over to you, please, and welcome, and the floor is yours.
Thank you, Liam. Hello, everybody. Thanks for inviting me, Liam, and the Mason team. When Liam suggested that I speak to this very experienced audience and qualified, my initial reaction was, why are they inviting me? What can I bring to this group of lawyers and regulators and other experienced people? But Liam convinced me that it's about sharing a different perspective, maybe a banker's perspective. So here I am. In our corporate finance team, focus on financial services, as Liam said. Of course, we debate the topic of consolidation trends all the time. This is critical in deciding which situations, which clients we focus on. So on one hand, it's an easy topic for me. On the other hand, after we look back, because we look back now and then at what we decided to focus on, we know that we get our views wrong all the time. Therefore, while I'm not shy in giving my views on the topic, I also remain very humble. So let's get into the topic. Most countries in Western Europe have already seen a lot of market consolidation, obviously. The great financial crisis accelerated consolidation. You can see these examples in particular in Greece, Italy, Spain, Southern Europe, generally. So much so that in several countries, concentration is close to reaching what people consider the antitrust regulatory limit at a national level. Still, in many other countries, there's one more or a few more merger transactions to be done, significant transactions. And I could take a lot of examples, but some of this would be confidential or subjective, etc. But like obvious examples that people talk about are Monte dei Paschi di Siena in Italy or Novo Banco in Portugal. In the UK, we've seen a lot of challenger banks coming out or emerging in the last 15 years. And so we expect some concentration to happen in that area. But what's left to do wouldn't be enough to feed, frankly, the large teams of investment bankers like me, specialized in the financial service sector. For example, Dutch market is essentially in the hands of three big banks. In Greece, you've got 95% of the assets concentrated in only four banks. And feeding into this market concentration trend, we've seen a lot of banks exiting their foreign positions, and the buyers have been primarily domestic, what you would consider domestic. The latest example of a big bank pruning its international portfolio is HSBC, with the sale of France and Canada and maybe others. And as a result, there are now few banks, very few banks, with sizable universal banking presence in more than 2 Western European countries. There are a few, but very few. Ireland is actually a case in point, with the exit of NatWest and KBC recently, in both instances through the sale to a domestic bank. So because domestic consolidation is pretty much done, people are asking if the next step is cross-border consolidation. The regulatory governmental authorities have encouraged consolidation, including across borders. And because they would like to see banks diversify risks, they would like the creation of a true European banking market. The European Commission also would like this. There are a lot of references to harmonization of banking regulation and supervision as enablers of that objective and trend. People talk about the integration of national deposit guarantee schemes across Europe. That's left to be done. And then finally, as if, finally we would see cross-border consolidation. So my bosses in our internal discussions, they challenged me regularly on whether we as financial advisors were positioned adequately for this possible big wave of cross-border consolidation. And the press feeds this expectation. An example often mentioned, and I'm not giving tips to anybody, I'm just reporting what the press says, is so in the press and equity research actually, is the combination of a UniCredit with SocGen. That's just an example. So in how we strategize about how to allocate our resources, I've taken the view that this is not likely to happen. I've taken that view for a while now. I've been right so far. And well, I hope it continues because otherwise I'd be wrong. And why have I taken that view? Well, I talked about harmonization across Europe. So harmonization of regulation and supervision has been very impressive. I think the extent of that harmonization would not have been expected before the great financial crisis. But there are a lot of areas, critical areas, which are left untouched, like the regulation, supervision of distribution of financial products, taxation, tax regime applicable to financial products, information disclosure, property laws, like repossession of property in case of mortgages. So a lot of these areas have not been harmonized that much. I started my career as an engineer in car manufacturing, so I can contrast with that sector. And the reason that car manufacturing has been consolidated in Europe is that the cars are the same pretty much across Europe. Consolidation creates economies of scale and cheaper cars. I can't resist the joke, which is that, as a Frenchman living in London, if everybody had the same steering wheel on the correct side of the car, economies of scale would be even greater. So there's still, maybe some harmonization in car manufacturing to be done, but by and large, it's done. In contrast, in the banking sector, a lot of differences. Products and conduct are very different. And in my work, I see little appetite to change this significantly. The obstacle to the required changes are just too deeply embedded in law, in culture, and full harmonization will take, I think, a very long time. And the effect of this is that banks derive little synergies from being in two countries. And I often think of the following examples: Santander and CaixaBank being present in Spain and Portugal, ING being in the Netherlands and Belgium. These are markets that are seen as close, as culturally close, and also with integration of businesses across these borders. So if it is and by and large, that integration is either not being tried or has failed. So if it is difficult to integrate between Spain and Portugal, or the Netherlands and Belgium, how about Spain and Germany? Or you can take any couple of countries. And so I think for cross-border banking consolidation to happen, harmonization must go much further. Another obstacle to cross-border consolidation is politics. Banks are seen as essential tools in the implementation of national policy. Banks hold people's savings. These are very sensitive topics. An interesting example in this regard, i.e. the sensitivity to the topic, was the example of Lone Star approaching Bank of Cyprus. It reminded all of us of how politics works. In response to Lone Star's proposal, that is friendly proposal, to the board of Bank of Cyprus, the government actually introduced a law to grant itself the golden power to block a takeover by a foreigner. So, so much for integration. I actually think that in the Eurozone, where the ECB is in charge of approving bank takeovers, acquisitions, potential acquirers should worry less about politics. ECB wants to foster integration and, as I said, the creation of a single banking market. And governments in this area, I think, frankly, despite my example of Cyprus, bark a lot, but often don't bite. This applies to banking and many other sectors, actually. But potential buyers, our clients, they do not want to test governments on this, which acquirers would want to start on the wrong foot. So in the end, politics prevails. I've talked mostly about the banking sector. I could have made similar comments about insurance. In insurance, there's much more cross-border presence, like big groups like Generali, AXA, Allianz, Zurich. They're in many European countries. So there's much more geographic spread among the big insurers than there is among big banks. I believe this will continue, but I would not call this cross-border consolidation. These insurers are basically pursuing a multi-local strategy. There is very little integration across borders. In fact, they're exiting countries where they're not strong enough, and they believe that they do not have the opportunities to build sufficient scale. So we see the same trend of domestic consolidation. It's just in insurance as in banking. It's just that it may be done by foreign insurers. So I've done corporate finance work in financial services for 30 years or so. As an investment banker, I grew up advising banks and insurers on buying other banks and insurers, and consolidation was the bread and butter of our business, mostly domestic consolidation when I started. But at this point, so you might be asking yourself, well, okay, domestic consolidation is done and cross-border consolidation isn't going to happen. Am I out of a job? And the answer is, fortunately, no. What we've seen in the last few years is the emergence of other players, specialist financial services provider. And they focus on part of the financial services value chain, right? So firstly, well, this is where a lot of value creation has happened. You've seen stock prices of banks, insurers, they haven't gone up much, but has been a lot of value creation in other areas, these specialist areas. They sit often outside of the traditional regulated sectors of banking and insurance. And traditional providers, you could say, especially in terms of value creation, have lost out or they haven't been focused on that. And there's a long list of these subsectors which have emerged. And in preparing for this talk, I started listing them, and I thought I got to 15. And I'm going to just rattle them off in no particular order, but just to give a sense. There's NPL servicing, online brokerage, wealth management, insurance brokerage, distribution of financial products like financial advisor networks, online brokerage and wealth management, digital banks, FX transfers, asset management, fund administration, custody, merchant acquiring, the whole payments area, insurance related services, private banking, stock exchanges. I could have listed more, but I stopped at 15 once I realized I had so many. So in each of these sectors, you see independent players emerging, often initially a spin-off from big banks. And so actually, rather than speak of consolidation, it's almost like the value chain of financial services is being fragmented. It's the fragmentation of the sector, of the broad financial services sector. But after that, where there are economies of scales, and you see cross-border consolidation. So in several of these subsectors, there are indeed economies of scale across border. You take asset management, while you might have two banks in two different countries, they have their own asset managers. Merging the two banks would create little synergies, so it doesn't happen, as I said earlier. But merging just their asset managers, often essentially captive, would create big synergies. So the first fragmentation of what I call the fragmentation of the financial services value chain is actually giving rise to the opportunity to consolidate financial services, but in a different way. When I started in corporate finance, as I said 30 years ago, we're not talking much about this. It was all about consolidation, banking and insurance sector, but now it's very different. And for us, as investment bankers, and I imagine for others like lawyers, many of you on this call, that is a challenge because the subsectors are very different from, when you go from one to the other. So it's not like in the old days where I can go from one bank merger to the next, from one country to the next, and apply very similar knowledge. I have to specialize much more. So that kind of cross-border consolidation is happening, will happen. It is less visible. It doesn't make headlines like my example of a merger, hypothetical merger of UniCredit and SocGen. Then another interesting area with regard to consolidation, I think, is the emergence of digital banks or digital financial products providers. They do not have, obviously, physical distribution networks. A great example is Revolut, right? It's all online, which I know is very, very strong in Ireland. It claims now about 25 million customers. And I was thinking, oh, when I was reading this, like, okay, I have to put this in context. And so I thought, like, oh, let me look at how many customers Crédit Agricole, the big French banks, which in several areas has 30% market share, how many customers do they claim? And the answer is, in France, they claim about the same number of customers. So Revolut, if you could just buy that metric, number of customers, is a very, very big bank, or very big. It's not a bank in the UK, but it's a bank in the Eurozone, and it's a very big bank. And Crédit Agricole, in the only other country than France where Crédit Agricole has a big retail or universal banking presence, in Italy, but it has only 1.7 million customers there. So in total, actually, in Europe, Crédit Agricole has not many more customers than it has in France, not many more than the 25 million. So it's about the same as Revolut. But Revolut has customers spread all over Europe, right? So Revolut is effectively doing some form of cross-border, let's not call it maybe consolidation, but market integration. And it's doing it organically and through technology. Another similar player, similar in terms of the trend, would be Klarna in a different sector, which is buy now, pay later, very famous, right? And very international and very big. It now claims 23 million active users monthly, 150 million active customers globally. So think about what you just said about Crédit Agricole. Very big player that didn't exist, a few years ago. Klarna is a Swedish bank. Revolut has a Lithuanian bank license, applying for a UK bank license for the top four groups, but still doesn't have it, right? So these are banks or not banks, because there are many other examples which are not banks, and they are integrating, at least consolidating financial services across borders, but without acquisitions. So these new providers are posing different challenges to bank supervisors, right? Technology and cross-border passporting within the EU are enabling these digital banks or non-banks to operate across border, but without domestic, or in traditional sense, domestic prudential supervision, right? Passporting has long been possible in theory or by law, and technology has finally made it real in big volumes. And I think that poses a particular challenge to national supervisors as they face these large operators coming into their national markets, but operating perhaps under different standards or supervised elsewhere. And because the growth of the likes of Revolut and Klarna has been phenomenal, of course, you've seen in the press, everybody has seen this, the valuations have been too, right? Revolut raised equity at $33 billion at the peak. I think Klarna 46 or so billion dollars. These valuations have come down a lot. Like Klarna raised money at only $7 billion recently, because of course, while these players have reached actually a huge size in terms of number of customers, they do not make money, or not much money yet. So that probably, I think, creates an opportunity for professionals like us, because we're going to see a shakeout in this area with a combination of old and new players, digital players, and then combination among the new players. And I think this is a very interesting area for M&A, because they have big size, there's huge market impact, but probably the current setup is not sustainable economically. A similar example of a new player revolutionizing the segment of financial services is Adyen, which is the Dutch-based leading merchant acquirer. Its market cap is now only, so to speak, 40 billion euros, which in bank terms would be huge already still. But in November 2021, it was over 80 billion euros, which might be more than any other European bank at the time. So unlike its more traditional rivals in merchant acquiring, Nexi and Worldline, which have grown essentially by amalgamating merchant acquiring carve-outs from banks, so the old sector in a way, Adyen has not done any significant acquisition. So the payment sector is another one which didn't really exist in its form now, with a lot of independence 15 years ago in Europe. But we've seen a lot of M&A and the revolution of the payment sector by several players without M&A. So you can see, a lot of shakeup, and I believe that we'll see a lot of banks still carving out their merchant acquiring businesses. So more consolidation to happen in this area. So I talked quite a bit about the fintech digital players. I saw that McKinsey reported that there are 274 unicorn fintech companies, i.e. valuation of more than $1 billion, with an aggregate value. That was in September 2022. It probably has fallen since then, but their aggregate market value was more than 1 trillion, huge number. And that, I think, creates a lot of potential deal activity, as I said. So in view of this revolution, large banks are, of course, responding, right? They're not standing still. They are developing their own digital offering. So I was not expecting cross-border consolidation. Years ago, I wasn't expecting it. Hasn't happened. And I expected even less. So as an investment banker, as I said, I hope I'm right. But I'm very optimistic in terms of M&A activity. I think there's a lot of cross-border to happen, but in subsegments of financial services. And there will be, again, M&A among the new fintech players. And so in conclusion, I expect I still have a job. That was the international perspective, or European perspective. So now I turn over to Stephen, who is a Irish specialist, and maybe can give his own perspective.
Thanks, Hubert. Very comprehensive, and that was very good. Look, I would echo a lot of themes that Hubert has mentioned, and a lot of those do resonate for the Irish landscape also. Just as we think about the landscape, I think it's important to touch on also the macro context that Irish financial services businesses are operating in. Clearly, we're in the middle of a rising interest rate environment, whereby ECB expect to increase base rates to 3.25%, maybe 3.5% at the outside. Inflation in Europe is coming across at about 9-10%, but in Ireland expect to have peaked at about 8% at the moment. And while still some distance away from the ECB's core target rate of 2%, the rhetoric in the market is that the pace of inflation is slowing, which is a real positive. As we look out of an uncertain economic environment driven by political, geopolitical, energy-related factors, the current expectation is that we will still avoid a recession, which is hugely positive. From a bank perspective, even though there is uncertainty out there, there's no signs of stress across the Irish banks' loan books, which is important as we also think about future corporate activity. What we have to really remember is that as we think about those higher interest rates, is the impact that has had on the Irish banks. It's been fundamental to the driving of additional profitability, and ultimately we're now in double-digit ROE territory, which is hugely positive. Lee mentioned a number of subsectors in the Irish financial services sector, so maybe touching on each of these. As we think about the banking landscape over the last kind of 15 years, it's fundamentally changed. It's gone from being hugely fragmented to having kind of 12 banks pre-GFC to 3 retail banks. In recent times, it's transitioned from selling non-performing loan books to there recently being a number of industry transformational transactions with both KBC and Ulster Bank exiting the market, all really driven by nuances of the Irish market with high relative capital requirements, as well as elevated risk weights, high fixed cost bases, and at that time, somewhat muted demand for their respective offerings. To put those transactions in context, those two and exits have in effect impacted north of 1 million people in Ireland, which is 20% of the population. As we look forward, we don't see further exits of mainstream banks, but we do see new entrants coming in, but more in different forms. And whilst it's fair to say that the Irish banking market is concentrated, there has been the emergence of a domestic non-bank lending sector, and all of that has really been funded by international capital, as well as a number of UK/European neo-fintech companies providing some traditional banking services, but not all by any means. In terms of the non-bank lenders, while some remain small and niched, others are evolving from single product offering companies to having scalable, diversified products and loan books that do compete head on with the banks. In addition, we also have the likes of An Post, and we also have credit unions operating in the broader sector. As we think about fintechs, we'd always think about this as kind of 2 strands of fintechs operating here. Those that have large customer bases, which is akin to the Revoluts, the Starlings, the N26s, and 2, technology business, which do offer an element of financial services, but they tend to be in focus on improving customer propositions, driving operating efficiencies. As of late, across both the Irish and the UK market, we've seen a lot of the incumbents actually working with the latter in partnership with the view to enhancing their product service proposition and or generating operating efficiencies. As Hubert mentioned, we have been cognizant of the level of investment made by traditional banks in digital to compete with fintech. That's expected to continue. And we've seen main banks invest billions of euro into these areas. And overall, despite fintechs encroaching on banks' activities, the point which I'll probably make is that fintechs will take a slice of the pie, but there's an awful lot of the pie to go around at the same time. From an M&A and consolidation perspective, we have started seeing some interesting developments, more so in the UK market as opposed to the Irish market, where neobanks have shifted from one side of the balance sheet to the other side of the balance sheet. So you've seen the likes of Starling acquire Fleet Mortgages, a Hampshire-based buy-to-let mortgage group, and also reportedly competing against Barclays to buy Kensington Mortgages. If I think about insurance, then from an underwriting perspective, to Hubert's point, the Irish insurance market is typical of a European insurance market, but it's actually possibly even more acute given it's such a small market. It's competitive, it's fragmented. There are a significant number of large European/US companies operating it. And as we know, there's only one Irish underwriting business in there. There's been very little M&A activity in there in terms of pure play underwriters. However, we would expect to see in the short to medium term, as insurance companies seek to either achieve a top tier market share in their core market or look at a way of exiting kind of subscale businesses. Reflecting the broader European environment, the insurance broking market has been hugely active in Ireland over the last kind of 4 or 5 years, and there's been somewhere between 10 to 15 deals done each year. The reasons why these are appealing the reason why these transactions have been happening is primarily because there's been quite a lot of private equity interest in the sector. This is due to the characteristics of those business and the fact that they're highly profitable, they have asset-light business models, they have consistent cash conversion rates, they have durable client relationships, in particular on the commercial side, and high retention rates. And they've been ideal for buy and build strategic opportunities. As part of that, what you've actually seen is a lot of buy and build strategies, and then those entities ultimately been taken out by European companies, such as like AJ Gallagher bought Innovu recently enough. Finally, just in terms of asset management, there's been no shortage of transactions in the fund admin space and servicing side, all driven really by regulation and the need to scale, and by regulatory factors including minimum substance requirements. Maybe just hand it back over to Liam now.
Thank you. Thanks so much. Thanks so much, Hubert and Stephen. Those opening remarks have really set the scene well for what follows in our panel discussion. There's 3 themes that I'd like to kind of draw out of what you've both said that I think will resonate with the panel. So the importance of regulatory policy and regulatory burdens and costs in either driving consolidation or potentially deterring consolidation was one theme that I drew out of that. The fact that even without M&A activity, consolidation in financial services is continuing organically in Europe and in Ireland through the extraordinary growth of technology-based firms. And I guess the third theme, if you like, that I drew was the fact that in most of the European jurisdictions, and as is the case in Ireland, there's relatively little scope for big transformational M&A transactions in banking and insurance in those core regulated sectors. But because of the trend towards fragmentation of the value chain, there's still plenty of scope for M&A consolidation through M&A activity in various of the niche subsectors. And so to go on to debate some of those issues a bit more extensively, Hubert and Stephen will now be joined by my fellow panelists from Mason Hayes. So first, if I can introduce Sarah Clunan, who's a financial regulatory specialist, Sarah O'Reilly, who's a funds asset management specialist, Justin McKenna, who's a corporate M&A partner with a particular focus on equity capital markets, and Rob Dixon, who's a corporate M&A partner with particular focus on private equity. Justin, can I start off with a question for you? There's only 4 financial stocks listed on the Dublin main market, and with 2 of those under majority government ownership. So a bit bleak from an equity capital markets lawyer's point of view. What's your view on the prospect of ECM activity against that background in the sector in 2023?
Yeah, thanks, Liam. I'm also very sad about that, the dearth of financial services stocks. What would you say about ECM activity? Well, they say about the capital markets, sell in May and go away. I think in 2022 it was sell in May and go away for at least a year. It hasn't been a great year. In terms of new entrants to the market, I would say there's no sign of that, and the general fundraising market out there is pretty bleak, as you say. There was one financial services sector IPO, which I think has been postponed indefinitely. So new entrants, don't see them happening. In terms of capital raises by the Irish banks, this is where I'm going to prove that I'm not Nostradamus by saying I don't expect much, which means possibly they'll all announce rights issues tomorrow morning or something like that. But I think they'll be driven by the sentiment in the market. Generally, you look at the Irish banks and FBD, they're all relatively well capitalized, stable share prices, stable or even going up. The increasing interest rate environment, of course, is positive for them. But in terms of actual activity, 2 of them are absorbing acquisitions without having signaled any form of a fundraising being required to do anything else. The third bank, AIB, the big story there, I guess, is relating to the recently announced state third phase of a sell down. Obviously, the state has exited from Bank of Ireland, and its stake in PTSB will fall to 62% from 75%. After NatWest takes its minority stake. So I think the big story coming out of the Irish equity capital markets so far as the quoted banks and financial services companies are concerned, or banks principally, is, I guess, the continued state sell down in relation to FBD. No sign of anything there, but I mean, who knows? But Stephen, you probably can say an awful lot more about state sell downs and give us more insightful comments than that.
Yeah, look, I think the environment that we're in now with higher interest rates has led to a fundamental re-rating of all the bank stocks over the last kind of 6-9 months. I think as people think about future sell downs, ultimately government policy will dictate how that all kind of plays out. Current government policy is not to hold these investments long term, and subject to market conditions, the government will exit these in a manner that generates the maximum value for taxpayers ultimately. As we've seen in recent times, the government has used kind of various different transaction structures, and which is all in line with European precedents, be it ABN, Lloyds, NatWest, and things like that. Around they've looked at block sales, trading plans, and directed buybacks, and all those mechanisms really set the blueprint as we look forward into 23 and beyond.
Stephen, you make a very interesting point there. Of course, its current government policy is to continue with a phased sell down of the stakes in AIB and PTSB. But I think Pierce Doherty has called quite publicly for the maintenance of a majority stake in AIB at least, over the long term. So obviously that any change of government could significantly impact on that strategy, I would imagine. I don't know, probably unfair to ask you to comment, but Justin, any thoughts on that?
Well, I mean, let me say these are my comments. That are my own and not those of my partners. So my partners are wondering, what on earth am I going to say? I really hope not, because I mean, even our centrist government has signed up to the bankers' pay cap, and I mean, how many bank CEOs do we need to lose in order to show that that isn't such a superb idea? So I'm going to call it and say it'll be a return to the 1950s, and a disaster if Sinn Féin gets their hand on the banks.
Typically forthright comments there, Justin. Right, we better move back, better move swiftly along. Stephen, staying with you for the time being, or coming back to you for the time being, the Irish retail banking sector is so highly concentrated as things stand at the moment. It's difficult, and this is consistent with what Hubert is saying about the wider European landscape. Difficult to imagine any scope for consolidation by M&A. And arguably, the public policy focus should be elsewhere, really, should be in promoting greater competition and access to the sector. So what role do you see for the government and possibly even for the central bank in that regard in coming years?
Yeah, I think the first thing to probably say is it's important to differentiate between prudential supervision and the promoting of competition. So the two very different things. We have seen recently the published banking review that outlines that the level of competition has to be monitored, etc., and certain measures are going to be put in place, including the CBI and the CPPC working a little bit more closer together. The banking review also talks about certain measures that would help kind of new entrants, even like promoting the use of open banking a little bit more. But to be fair, that's been around for some time as well. From a broader competition perspective, like we have seen in the past, the government take welcome and proactive steps to help drive economic activity through the use of some of the government entities such as ISIF, for example. So ISIF has come out of non-bank lenders. ISIF clearly funds HBFI, Home Building Finance Ireland, which was set up to help fund the delivery of new homes, which were badly needed across the overall economy. On top of that, it also set up the SPCI, which plays an active role in providing finance to both non-bank lenders and regulated lenders to help drive further funding into the SME market, So I think that's the main ways in which is being put in place at the moment.
I suppose one thought I'd have is, are these ideas really, the ideas in the retail banking review, really radical enough to deal with the levels of concentration that we see in the Irish market at the moment? And one of the thoughts that I think comes out of the retail banking review is that in the short to medium term, competition will be provided by An Post, the credit unions and the digital banks. But now, equally, it's very difficult for government to intervene so fundamentally in the market as to cause radical structural change. But do you have any thoughts on whether more could be done?
Yeah, look, I think that's it. And I think even if you think about the non-bank lending sector across Ireland, it's probably bigger than people think. So there could be 20 odd firms operating in that space. Some are small, so you'd expect to see some consolidation in between each of them as things do evolve, and all driven by the increased kind of regulation that they're going to have to all adhere to in time. So with increased regulation means increased costs within each of those businesses, and they'll need to consolidate as well.
Going back to the cross-border consolidation point that you raised, you mentioned that the ECB, and I think the ECB has been quite public on this, that they would like to see more cross-border bank consolidation in Europe. But do you think that there's an element of sort of wishful thinking or aspirational thinking on the ECB's part here? I mean, is there much that they can do in real terms?
Yeah, I think that's a big challenge for them. So that's a policy objective, but I don't think that's really part of the mandate, right? Their mandate is to make sure banks are solvent. The mandate is financial stability. It's not really to create a single market of banking, let's call it. And I think the big obstacles that I talked about, which are legal and regulatory and even cultural, political, etc., cannot be addressed really by the ECB. So I don't see the ECB as really able to foster that consolidation across market. What ECB has done, but I think this applies to both domestic and cross-border consolidation, so it's not specific to cross-border, is basically lowering the capital requirement for consolidation, right, by changing a number of things. They did that during COVID. And that has a significant impact, but it's not related to cross-border. And as I say, I think the obstacles to cross-border are elsewhere, and they cannot be addressed.
Yeah, and that's a very important point that you make, I guess, and one that often, as lawyers and compliance professionals in particular, we tend maybe not to focus on enough, because when we think about the obstacles, the regulatory obstacles to consolidation, we tend to think about the change of control process and all of that, which is very important, but we tend not to think about variations between the conduct of business rules in different countries and the obstacles that very specific or bespoke conduct of business provisions in particular jurisdictions can cause for acquirers that are seeking economies of scale.
Yeah, that's it. I mean, this debate, as I said, internally we have it all the time, right? As we allocate resources, we focus on clients and transactions, etc. And frankly, this is something that I've been thinking about, like, okay, am I right and wrong, as I said? Because we've been waiting. For example, one trend that I started in this business a long time ago. We were always talking in the 90s about the privatization of cajas, right? The savings banks in Spain, and everybody said, oh, it's going to happen, it's going to happen. And then at some point, people would say, look, I've been doing this business for 20 years, it's never going to happen. Well, it happened. It happened as a result of the financial crisis, and you can see why, right? It's understandable. But cross-border is very different. That was financial crisis, there was politics, etc., playing into the privatization of cajas. But for this one, I think is different. It's more economic. It's banks actually that are not really seeking to go across border because of the lack of synergies. Because again, things are different, and so that one is hard to see how it's going to be changed. And I think European Commission would like to, in recognition of maybe what I say, they would like to also promote that harmonization in many other areas than just supervision and regulation of capital, etc. But that's just too deep. That goes, if you think about mortgages, ownership of property, etc. I mean, you guys are much more competent to talk about this than I am. But I understand that they are so different from one country to the other, and that goes back centuries, really. So it's unlikely to change.
Yeah, it's a tough one. You're absolutely right, Justin. Assuming that we don't have a change of government and the sell down of the state's stakes in AIB and PTSB continues, at some point we will have 3 privately owned and publicly listed banks in this country, and the potential for an acquisition might arise. But doing an acquisition of a strategic bank is hardly a cakewalk, is it?
No, it isn't at all. And just before I mention anything about the banks, there is another interesting scenario playing out in relation to FBD, which is, of course, the 4th quoted company. So a private equity firm apparently owned by Mr. Waters, who's the founder of Panda Waste, has been flipping in or around the 10%, including by the use of CFDs as recently as late December. And a Norwegian tank has been placed on the lawn by Protector, the insurance company. But I mean, there's a lot of entrenched shareholdings there, but who knows what might happen. As regards the Irish banks, I think there's an interesting parallel with a fairly not very well known in Ireland company, Bank of Cyprus PLC, which is incorporated here, and which has been the subject of an approach from Lone Star, and a hostile approach which has been rejected 3 times. And ultimately, Lone Star has backed off and has stated its intention not to make a bid. But there's actually a statement from the bank which was telling, and I think would you could see how it would play out here. In addition to fundamentally undervaluing the company and its future prospects, the board believes that the proposal from Lone Star does not adequately address the complexities of completing a transaction to acquire Bank of Cyprus, given its strategic importance to Cyprus. So you can imagine if anybody like a private equity firm was to make a hostile approach to one of the Irish banks, how that would play out. I could see that happening in almost the same way. We also have other issues, the regulatory threshold of 10% and the existence of the restrictions on stake building under the Irish takeover rules. But I just think you'd want to be determined to get into the Irish market. And I mean, there's lots of cheap European banks available for sale that are easier to buy, frankly, that are not nearly as strategic. And that's before a change of government.
Thanks. Hubert and Stephen, can I switch sectors now, and we'll talk a little bit about insurance. So rates are hardening, as we know. We saw the recent renewal season at the end of 2022, beginning of 2023. Reinsurance rates have hardened very significantly. So theoretically, in a period of hardening rates, capital should flow into the insurance sector. So targets should become more attractive. What's your prognosis in terms of insurance M&A activity for 2023? I don't know, Hubert, if you want to take that one first.
As I said before, I think this has been going on for decades. I think it will continue. I don't think that's related to hardening rates or not. I think there's more consolidation to do. It's similar to what Stephen said about Ireland, I imagine. So you go country by country. Most countries still are pretty fragmented. And it's just that there are a lot of synergies to be had from combining players and OPEX synergies mostly. So nothing to do with the pricing side of policies and products. And I think that will continue. One big obstacle in insurance is that there are a lot of mutuals. And obviously these react to different, or they pursue different objectives in terms of, well, shareholder remuneration. So there are no shareholders. And so I think that is an obstacle, not in a bad sense, but nothing against mutuals, but it's an obstacle to consolidation, because obviously you cannot just make a takeover, and and maybe the objective, as I said, in terms of profit making is different. So I think it will continue, but it's slower than if everybody was listed.
I think from an Irish perspective, we'd see something in the underwriting space. It is very competitive, as I kind of mentioned earlier on, but I think there's likely to be something there. It's at a stage that it's going to break. The insurance broking market, as I mentioned earlier on, 10, 15 deals done every year for the last number of years. It continues to be really fragmented. I mean, there's the best part of 300-400 players in there. Now, some of them are really, really small and wouldn't be suitable for M&A activity, but there will still be an element of that to go. I would say, as you look at the outlook from where we're sitting today to what has been, it's probably a little bit more mixed from versus the last couple of years. I mean, the factors that will support activity is that it continues to be fragmented. There is an element of succession issues within brokers at the moment. Scale will continue to drive shareholder value in this industry as brokers receive higher commissions for greater levels of premiums placed with the underwriters. Regulatory costs are increasing. So from a company perspective, you need to spread those regulatory costs over a larger base. And then capital continues to be attracted to asset light, high income profile businesses. Whilst there are positives, these are balanced against a number of headwinds. One, rising purchase prices. So if you went back 5 years ago, brokers were being bought by 5-6 times EBITDA. At the moment, it's high single digit, double digit EBITDA multiples, to be fair. And even with that difference in valuation multiples, we're in a different environment we are now versus where we have been the last couple of years, and capital has become more expensive. So those factors will alone inhibit certain transactions being done.
Mm-hmm. Interesting. And do you think there's even an argument that maybe some sellers need to start becoming a bit more realistic, that they're just not going to, there was this perception, if you own a broking firm, you're sitting on a gold mine, and you could get 15 times EBITDA was kind of where you started. Do you think there's an argument that ship has sailed? And
there's a bit of that creeping into the market, and what you've seen the larger brokers get the higher multiples, and so that's a function of, because they're more profitable and they've more scale, and they can kind of can move their clout around a little bit more, to be fair. Smaller brokers will not get those kind of multiples, and they shouldn't, because they're at different stages of development, to be fair. But again, the valuation is subject to what the economic environment looks like over the next kind of couple of years as well.
Leon, maybe I can just
go ahead, Hubert. Yeah,
just one example, still high multiple for transactions is in France. April just bought by KKR from CVC, roughly 16 times EBITDA, 2.3 billion euros, right, enterprise value. But to Stephen's point, that's a big broker, market leader in France in its segment. So for big brokers, you still get very high multiple, even though financing market conditions have changed, have deteriorated so much, right? So it's quite interesting.
Yeah, your multiples will be capped based on what the larger companies trade in the market at. So that's the maximum multiple you'll ever be able to get out of something, to be fair, and then it just depends on where you end up on that spectrum.
Rob, drawing you into the conversation now. So we've, coming from the insurance broking sector, obviously a lot of that activity is backed by PE, and the PE acquirers are huge players in the M&A markets these days, across a number of financial services sectors. What are your thoughts on the prospects for PE-backed activity in 2023?
Thanks, Liam, and agree with those comments about the importance of private equity in the market in Ireland. There's been a growth of private equity over the last 5 years in Ireland that's actually exceeded anything in the rest of Europe, which there's been great growth in Europe, but it's averaged 30% per year growth in deal volume. And just in terms of answering your question about 2023, just to look back, I mean, there was this frenzy in 2021, 2022 exceeded for private equity transactions what had been there before 21. Obviously, it didn't quite match the frenzy of 21. But I think you're looking at a lot of factors there in 23 that suggest there could and should be optimism. Stephen's mentioned a number of the headwinds there, you know, in terms of valuation gaps, I suppose, in expectation and interest rates, inflation, geopolitical factors, all the rest of it. But I think the sense is that for a lot of reasons, private equity activity in these financial institution subsectors will continue. I think it's the kind of the quality of the assets. If you look at some of the other sectors that are out there, unfortunately, some of the technology subsectors, for example, have had an absolutely horrid year. And when you compare that to something like insurance broking and some of the very strong factors that Stephen's talked about there in terms of a reliable source of stable income and customer base and EBITDA generating business, particularly where there's a leveraged transaction and you have ongoing repayments, I think that points to a positive outlook for 23 in that sense. Then you've got to look at sort of Ireland, how it's developed as well as a hub for PE, as a kind of sector 10 or 12 years ago, it just wasn't there. Whereas now you've got this domestic PE houses and then international as well. Obviously you've got the mid-market in the UK that's investing here. And I think that gives a kind of backbone to us once PE houses are kind of used to trading and used to investing in Ireland, that continues as well. And you have also the necessity point. We've got this wall of money in private equity. As of December, the middle of December 2022, the dry powder in private equity globally was almost at $2 trillion, which is higher than it's ever been before. And that's not, just to bear in mind, that's not some fella having money in his bank that he can decide what to do with. They have to invest that. They're mandated to invest that. They're under that pressure. So there's that, that need to do deals. But then in some subsectors, there's the need also that they can't sit around either. So you look at fintech, for example, where there's there is a runway that only goes a certain length, and you kind of late 2022 with valuation gaps, a deal mightn't have happened. So as you get through 2023, there will be that pressure from the other side as well to actually transact. So I think for a number of reasons, despite all the headwinds, despite the caution, I think there is a lot of reason to be optimistic about PE-backed activity in 23.
It's great. And Hubert, there's been some skepticism, I think, in some quarters in Europe. I think some regulators are a bit wary of PE houses as acquirers of regulated institutions. But I think you work quite a lot with PE houses as potential acquirers. Do you think that skepticism is beginning to recede in certain areas?
Well, first, I mean, there is always skepticism, right? And in particular, it's because private equity funds or managers, they have a shorter term horizon, right? So it's different from a strategic buyer. And they like to run things on a shoestring, so to speak. Nothing bad, but with as little capital as possible, because that makes return higher. And they like, and it's similar, it's related, but they like to extract capital as fast as possible and as much as possible, right? So there's always going to be some skepticism, I would call it, but well, there's been a lot of activity, like Rob said, right? So especially during the financial crisis, because strategic players, the traditional players, they didn't have the capital, and private equity filled the gap. And you have big banks like HCOB with Cerberus or Noble Bank or Lone Star, right, which are owned only like strategic banks or systemic banks owned by private equity firms. So I don't think that will go away. One big variable is, of course, valuation, right? As bank valuations go up, maybe with rising interest rate, that becomes less attractive. But there are still quite a few banks that are, I would say, not trading super high, well below book. That's attracting. That's attractive. And then there'd be here and there more distressed situations, and private equity will play. What we've seen super supervisors do, prudential supervisors do, is basically ask for more capital. If private equity comes in, they say, well, okay, my solvency requirement becomes a little higher, and then the private equity buyer has to decide whether that's worth it. But generally, I would say that private equity has established itself as a good holder of financial institutions. Actually, there are several private equity funds that have a very good track record in terms of behavior, governance. I think actually we've seen regulators recognizing that private equity brings discipline, accountability, and return. The best way to be solvent, or one good way to be solvent, is to make money, and private equity tends to make money. And I think I've seen over the years, maybe over the last decade, because initially I think at the beginning of the financial crisis, like ECB was very skeptical. Well, it didn't exist, but I mean SSM I meant. But over time, so either national or SSM, we're skeptical, but they've seen that private equity restructures firms and creates value, and good names basically have behaved well. So I think there's a lot of acceptance of private equity, actually.
Great. Just to keep our audience updated, so this webinar was timetabled to run until 12:30. We're going to aim to finish by 12:15 to give you back 15 minutes. So I'd encourage you to stick with us. Sarah O'Reilly, just moving over to you, and we've been talking about private equity. One of the areas where PE money has particularly been driving deal activity is the asset management industry. What are the fundamental factors that you think have been going into the level of consolidation that we've seen in the fund management and fund services sector in recent years?
Yeah, thanks, Liam. I think what we're seeing in the asset management sector, it's predominantly activity on the fund administration side and fund management companies, where that activity is mainly taking place. And I think there are three key drivers around that. Firstly, the driver is to increase market share and global footprint, and also, as Hubert mentioned, to create synergies. And the other is to offer a one-stop shop solution for clients. And the third, I think, is the increased regulatory burden and substance requirements being imposed by regulators. And I suppose if you look at each in turn, the drive to increase market share and revenue can be seen in a number of acquisitions, one of which is Apex Group, which, as we mentioned previously, is, as we talked about, private equity backed. This is one of the private equity-backed administrators who's been very active in the market in the last number of years, acquiring SAM, Mainstream, and a number of other niche players. In fact, their AUM has increased from 50 billion to 3 trillion since 2017. And I think what the drive there is to drive and increase the AUM with the ultimate goal of eventually IPOing. We've also seen the CSE acquire Intertrust. That was more around the creation of synergies to again widen the global footprint and improve the service offering by offering, combining the strengths of those two administrators. The other driver I mentioned is the one-stop solution. So we're seeing fund administrators acquire fund management companies and vice versa. Examples of this would be the acquisition of Centaur by Waystone and the purchase of Ballybunion, which is a fund management company, by JTC. So the one-stop solution is investment fund clients are looking to deal with only one entity for all their servicing needs. So it just ultimately reduces costs for clients. So I think that drives a lot of the activity among the service providers. The other key trend is the increased regulatory burden and substance requirements imposed by regulators. The regulatory and resourcing costs of doing business for fund management companies in particular is increasing all the time as the regulators demand additional headcount. And in order for these entities to comply with the governance and oversight requirements imposed by regulators. And I think that's driving smaller players to either consolidate or shut up shop, with bigger players also in consolidation mode. We've seen Waystone acquired KB Associates and Cairn acquired AMX recently. I suppose just looking at whether we think you ask if these trends are going to continue into 2023. I think with the headwinds, inflation, rising interest rates, significant slowdown in the global economy, I think there will definitely be a commensurate slowdown in M&A activity, particularly for mega deals, due to the cost of capital raising and the lower valuations for these sellers. And we've already seen this in the State Street BBH deal, which was terminated before Christmas. And one of the reasons cited, which was the regulatory issues, was the challenging financial services M&A environment. So I think the focus will be for these companies on integrating acquisitions already achieved. And also I think smaller administrators looking to cash out may not now get the price that they're looking for, so may hold off until things improve. However, the good news, I think we will continue to see consolidation on the fund management company side, with the smaller players, as I mentioned, being forced to consolidate to meet the headcount requirements from the central bank. And the central bank recently in December noted in an industry letter that it expects the level of resourcing to be continuously monitored and grow in line with the nature and scale and complexity of the business. So, and we're aware that the central bank is reviewing firms to make sure that they have sufficient resourcing. So I think on the fund management company side, I think things are positive. And I think on the fund administration side, there'll be a slight slowdown due to the headwinds that we're seeing in the global economy.
Sorry, thanks for that, Sarah. And moving to another Sarah, to Sarah Clunan. Sarah, a theme with a H. The theme or one theme in our discussion so far has been regulatory issues, regulatory policy, regulatory barriers, etc. And obviously, in any acquisition of a regulated entity, that there can be regulatory obstacles, there can be challenges that need to be overcome. Can you just talk through briefly for our audience before we move to questions, some of those regulatory challenges and obstacles and how best they need to be managed in the context of a proposed acquisition by M&A?
Yeah, thanks, Liam. I think we've kind of touched on some of them already. So we mentioned conduct of business rules and the cost, I think Stephen's mentioned, of regulation, and equally, Sarah's mentioned probably one of the key drivers around regulatory costs more recently has been the substance requirements. Just to, I suppose, flag some other ones that have come to mind. And I may be stating some things that are quite obvious given the profile of the audience, but I do think it's worth highlighting both for those experienced in acquisitions or in the financial services space and those new to regulatory frameworks is the fact that the regulatory process itself and what needs to be implemented as part of M&A transactions or acquisitions, the regulatory process needs to be weaved into that process from the very outset. From a timing perspective, it's really important that on day one, all stakeholders are aware that the schedule will be somewhat impacted by the regulatory process. And sometimes if a buyer isn't familiar with the regulatory space, that point can be lost a little bit. Really obvious point is to some of us is that it's a prior approval process that regulators are involved in, and unfortunately I have been involved where that again has been missed, and we've people coming to us who've already done an acquiring transaction or a qualifying holding transaction, and you don't want to be in that position going to a regulator and trying to explain yourselves. So I would say this as a lawyer, but it would be really important, in my opinion, to have the right individuals involved and advisors involved at the very outset, so those types of mistakes aren't made. And again, just pointing to the timing perspective on the prior approval piece, depending on a transaction and the complexity of a group, you might have a number of different regulated entities across a number of different jurisdictions, and a number of different regulators will need to be involved and go through that approval process. So again, really imperative that that's woven into any schedules or frameworks that are put in place at the outset. Commercially, on the timing point, I think buyers need to be aware of any slippage in that timing, be it due to maybe the level of detail that's included in these notifications and the scrutiny that a regulator applies to those notifications. Commercially, that's going to have an impact on timing, of number one, completion of the M&A transaction itself, But equally getting back into the market, you could be losing market share. You could even lose some key individuals or you know, senior management as well during that process. So commercially, I think those are just things that need to be flagged at the outset. Another point, and again, this could seem quite obvious, but the scrutiny that's applied, I've mentioned there on these notifications, you know, you're looking at things like the financial status of the acquirer. Does it have the bandwidth in the event of any, you know, winds being thrown in like COVID or other issues coming into the fore? And equally, how can they support the target in times of difficulty for them? You've got fit and proper assessments as well that might apply depending on the type of acquisition and whether or not there's new senior management coming into play. So again, just be ready for that kind of level of scrutiny. Why is the transaction occurring in the first place? You know, what's the strategy behind it? They're all things that a regulator and the central bank will be particularly interested in hearing. And again, that goes to having the right people involved in the process. You know, there's some buyers out there that have really good resources in-house and they can take care of these notifications and know the level of detail that's required. But if you go in with kind of superficial information or high level information, that's just not going to cut it. And that again can impact on the timing. I'm just conscious of time. Another point which I think is really important is around the due diligence process. You have to obviously go through that process if you're acquiring any type of entity, but particularly in respect of regulated entities. I think, again, it's important to have people that are aware of the particular type of institution that's involved and the issues that might be important and that might come up in a due diligence process. So I think we've mentioned I obviously have a particular interest in the fintech space. So if we take like a payment institution or an EMI as an example, you know, during a DD process, you might come across correspondence on a number of different regulatory issues that the central bank might raise as part of like its ad hoc supervision of regulated entities. And say from a PI or an EMI perspective, safeguarding might have been looked at. And unless you're familiar with the space, you may not appreciate the complexity of that point and the issues that it can raise if you fail or if a firm fails to adhere to its obligations in that respect. So again, having people with the experience in those areas, I think, is key. And then kind of linked with the DD as well, I suppose, or the overall M&A transaction as well, and it's worth raising, is reps and warranties. So, you know, obviously you'd have a rep saying, you know, we comply with all applicable legislation and guidelines, and that's great. But I think our experience over the last couple of years on the types of transactions and M&A transactions we've been involved in is that's not really going to cut it anymore. And you need that additional protection of more granular reps. You know, the whole idea behind that process is to drive disclosure. But unless you ask maybe in a pointed way, you're not going to get the answers that you need in order to provide that comfort for a buyer. And I think, you know, you could fix issues, that's fine, and you throw money at them and eventually you might make that money back. But I think one thing that's more difficult to maybe paper or cement over after the fact is the reputational damage that issues from a regulatory perspective can cost a buyer or a firm down the line. And again, another point as well is just being fully aware of, you know, you take on those prudential requirements and obligations after an M&A transaction is completed. So just being aware of that as well as part of that process. So they're just a couple of other points I thought were worth raising.
That's super. Thanks so much, Sarah. And before we move to audience questions, maybe we'll take a look at the results of the poll, Sinead, if you want to maybe put those up. So we asked, how much additional consolidation activity do you expect in Irish financial services in 2023? 42% of you expect more than 2022, 35% similar to 2022. So the good news for the advisors and lawyers among us is that we're likely to be at least as busy as we were in 2022 and hopefully busier. How significant do you think regulatory policy is as a driver or deterrent of consolidation activity? 50% of you thought it was somewhat significant, 44% very significant, and only 6% not significant at all. Should financial regulators take competition and consumer choice into account when formulating policy? 96% of you thought sometimes, which is very interesting in the context of our central bank currently having no mandate to foster competition and consumer choice. No economic mandate whatsoever. Then please state your work area, which is really more for statistics. So 50% lawyers, it seems, who answered the question. So may have a bearing on the output. Just in terms of questions, we're aiming to finish just in 3 or 4 minutes. But there's one very interesting question here which I wanted to take. And Hubert, I'm going to put you on the spot a bit because the question is specifically addressed to you. If you're comfortable to say a few words on it, do you have a view on regulatory arbitrage and on the European perception of the Central Bank of Ireland?
Regulatory arbitrage, and the view of from who?
The European perception of the Central Bank of Ireland. Now, I think European perception, that's that's very broad.
Yes.
Let's stick with the regulatory arbitrage aspect. Do you have any thoughts on regulatory arbitrage generally as it may apply to consolidation in the sector and M&A activity in the sector?
Yes, I have views. I don't know if I want to share all my views, so I need to think for a few seconds. But I mean, I think this is. I think there is. I think I mean, obviously, in relation to the size of the country, the Irish financial services sector is very big and prominent and has been successful, right? So a lot of people who have no activity in Ireland are quite aware that there's a lot of activity in Ireland, and among regulators, that I've talked to in Europe, there's a feeling that the Irish regulatory authorities don't always have sort of apply the same standards. That's not a question of high or low. It's more a question of different, I think. And, I think there's a frustration almost, I would say. And so there's a wish that it would be more harmonized. Obviously, like, if you take the SSM for systemic institutions, that's more harmonized, but not in all areas, because as we just discussed, there are many areas of regulation that are not captured under SSM anyway. And then you have all the non-systemic institutions. So yes, I would say that generates a lot of controversy, I think, on the continent.
Interesting.
I'll leave it at this.
Yeah, you've been very diplomatic. One thought, just I might add, because I think it's a difficult one to take a question on. There is a question in the dialogue box. Any thoughts on credit union merger activity and their possibility or not of providing competition to the Irish banks? And I just maybe leave you with this. It's more of a thought. This is obviously a very important theme in the context of the government's retail banking review. And it is something that I know the credit union movement is going to be engaging with and needs to engage with very seriously over the course of the next 12 months. But clearly, in order for the credit union movement to provide a full service alternative to the existing 3 major retail banks, there will need to be some fairly fundamental thinking and some fairly fundamental restructuring. Whether that involves significant credit union merger activity, I mean, one would speculate that it would need to, just in order to achieve the kinds of economies of scale that would be needed before credit unions could move, for example, into mortgage lending on a big scale. But I think, look, this next 12 months is going to be a period of considerable introspection in the credit union movement, and probably, and a good time to have those thoughts. I think we've reached 12:15. I had said we were going to try to give you 15 minutes back. I think we're in a position to give you those 15 minutes back. So I'd like to thank all of my fellow panelists here from Mason, Hayes and Curran, Justin, Rob Dixon, Sarah O'Reilly and Sarah Clunan. And in particular, I'd like to thank our 2 guest speakers who generously gave their time and joined us today, and who've really been fantastic. Hubert Vanier from Deutsche Bank in London, and also Stephen Kane from Goodbody Stockbrokers here in Dublin. So thank you so much, everybody, and we look forward to you joining us again